Let's get another view now on the South African gross domestic product number that was released earlier today and shocked most economists. Let's see if this chief economist is as shocked as the other people we've spoken to. His name is Maarten Ackerman. He's from Citadel, a senior advisory partner and also chief economist, as I said, at that institution. Really was very, very bad indeed, Maarten. Now, I just want to do something that I didn't do with the previous commentators. I've just received a tweet, or just looking at a tweet from a chap that you know called Mike Schussler. It says here, South Africa's economy shrank in the first quarter. This makes the current business cycle the most extended downward phase ever since the Second World War, probably the longest since the Great Depression of the 1930s. 52 months and counting, thanks Mr. Zuma. Do you agree with that? Is that right?
Yes, I think we're definitely in this downward phase. And, I think people probably expected too much, given that President Cyril Ramaphosa is now only in his first 100 days.
Yeah.
So what we're dealing with in this number that's been printed today is still legacy. So you can't really expect all the changes that they've started implementing since January should already result in the economy turning around. That will take months, if not years. So I agree that, this number quarter on quarter annualized is definitely the lowest we've seen since 2009. And it's been a bit of a shock. We did expect a low or a negative number, but definitely not as deep as minus 2.2. So a bit of a wake-up call that, this whole thing about Ramaphosa, there's still a lot of hard work ahead of us. And changing the GPS coordinates of a ship doesn't mean that you make the turn in a couple of hours. It takes time.
Yes, indeed. It's a good analogy. But let's also contextualize this number. The lowest or the sharpest contraction in the South African economy as measured by gross domestic product or GDP in 9 years. And of course, we know what was happening 9 years ago. I mean, everyone was under pressure. This time, we seem to be going it alone, which is the most disturbing thing to me.
Yeah, I think, currently, there's a little bit of tension in emerging markets for various other reasons. But we do know that for the past 9 years, we didn't benefit from a global recovery, which is very, very sad because we are a very open economy. And up until about 2010, whatever happened in the world had a direct impact on us. Now, since then, and we know the reasons, it's been state capture, corruption, and the likes, definitely took away that opportunity for us to benefit from a massive global tailwind. And my concern is that, heading into the next 18 to 24 months, the global tailwind is probably going to get softer and might even turn into a headwind. So, we've got a very small opportunity to actually get our act in order to actually get growth at least back into numbers where we can see some structural changes taking place, jobs being created and the like.
Yes, you actually preempted my next comment, which was going to be, most economists that I speak to say that there is going to be a slowdown. We may be at peak growth when it comes to certainly when it comes to the United States of America, maybe not India and China, but there'll be knock-on effects if the US does start to peak. And if that does happen, then we haven't participated in the upside. And as you say, there's a very small window of opportunity for us to do so. We have to start right now, which we haven't done given these figures. It leaves us incredibly vulnerable to a global downturn, does it not? Especially with trade wars being talked about all the time.
Yes, and definitely, I agree. If you just look at the export numbers in this print this morning, it's down 16%, which is an indication of some of the softness we've seen in the global economy year to date. We know that the global economy is currently experiencing a bit of a soft patch, excluding maybe the US. And add to that the fact that we've seen the rand so much stronger on the back of President Ramaphosa coming in and making significant changes. So we are sensitive towards our exports numbers, and if the global economy is slowing down, it will definitely hurt us. And what worries me even more is that the budget in February looked reasonable, and as a result of that, and as a result of President Ramaphosa addressing a lot of concerns like the state-owned enterprises and the likes, we avoided the downgrade. But the reality is that if this kind of growth number we've seen today, well, number one, this will make the estimate of 1.5% that they've used in the budget quite a bit of a challenge, because it means that the following quarters need to be quite strong. And immediately this is putting all the fiscal targets under pressure again. So I think we, for a moment, forgot about the downgrade risk in SA. But this just make us realize again that it remains reality. And that is a scenario that you definitely want to avoid, especially if the global economy is also slowing down.
Quite right. When you look at the numbers, which were the ones that really stood out for you? Obviously, agriculture nearly 25% weaker, mining nearly 10% weaker, nearly 2% down on construction, manufacturing 6.4% down. I mean, down across the board in varying degrees, even construction, which is coming off an incredibly low base, down 1.9%. All in all, nothing to really cheer about.
No, I think, all those numbers that you referred to is actually the numbers where we need to see positive growth, because that's, call it, the job creation engine of the economy. Now, as long as nothing is happening there, we're not going to make a dent in unemployment. The biggest contribution came from government spending. That was up about 1.8%, which is also a concern in itself, because that's on the back of more public employment taking place. Now, we already sit with a bloated wage bill, the biggest compared to other OECD countries relative to our GDP, and one of the fiscal targets that we need to address going forward. So this doesn't help if the government is growing, and it's just adding more strain to the fiscal situation. The agriculture one, in a way we expected that. I've said last year that we can't expect agriculture to continue growing at the numbers we've seen last year. Yeah. That obviously came from a very low base after the drought with a record crop season. So that was almost expected to say, well, we're measuring now from that high base. Agriculture last year increased by about 17%. It is a small sector, but nevertheless, measuring now from that higher base, that kind of decline was in a way expected. But, tough numbers altogether, especially on the growth side of the economy, where we need to see some radical changes taking place.
Look into your crystal ball, if you would, Maarten, and have a look at the midterm budget policy statement, which will be coming up. And when is it? When do they have it? In October, something like that.
October.
These sort of numbers, which won't be replicated in the second quarter, we hope anyway. But the fact is that the growth target of 1.5% that you mentioned from the Treasury isn't going to be hit if we don't pull up our socks. Now, if those socks aren't pulled up, then it has implications for tax receipts again, doesn't it? Which has implications for the bond market and for the rand, yes, and for public borrowing, a public sector borrowing requirement, etc. So it's all linked. Just this one figure, you have to look forward and say, goodness me, this could be quite impactful, even though it's only a 3-month figure.
Yes, you're 100% right. The rating agencies clearly said that it's not just about the deficit or the debt to GDP, but we need to start getting proper growth coming into the economy. Without that, we're not going to increase revenue. And, so this is a bottom line number. So we need to get this right, and the rest will follow. So I'm still positive that, I don't expect that we'll see a similar number in the second quarter. Hopefully not, because that will mean we're in a technical recession. So I do think that we probably rebound from this low base, but it will be hard work to actually beat that 1.5. Beginning of this year, I think confidence and optimism was quite high in SA, a very sharp rebound in consumer and business confidence. And on that basis, Minister of Finance said that they're probably going to up the numbers in the October budget. But I think now, we're probably back to maybe 1.5 is more realistic. But having said that, we don't underestimate the rebound in consumer confidence and business confidence, because that is the first thing that you need to correct. So a lot of people felt the positive factor since President Ramaphosa came in. We've seen it in consumer confidence. We've seen it in business. And in any economy, you can go and look at US, Europe. That normally leads the rest of the recovery. So if all the policy and all the changes that they're currently implementing, if they keep track with that, and we do have a more positive environment, that should longer term and in the medium term support the economy. So the one good number that I'm more positive number that I'm taking from the print today is that the consumer expenditure increased by about 1.5%. So that just shows us that even in this tough environment with petrol going up, the currency slipping again, we had the VAT increase, that the consumer remains rather resilient in a very tough economic environment.
Maybe people were spending ahead of the perceived and now real petrol price rises. It could be that, and that could be why that figure was good. Maybe people buying before the VAT went up, because it is a quarterly figure. Who knows? What are the interest rate implications? Because on the one hand, the Reserve Bank has to say, well, maybe we should be more dovish now because we need to get this economy going. On the other hand, the figure that we've just seen has weakened the rand, and we are inflation targeters. And with petrol price going up, we can't be more dovish. Terribly difficult situation for them.
It's probably been difficult for them for the past 2 years. So the outlook for inflation is probably to the upper end of the target. And for that reason, they would probably be very, very slow on declining interest rates any further. That's on the one side. And on the other side, although they're not physically doing that, but if the US keep on hiking and there's another 4 interest rates on that side of the world, that means a stronger dollar. So we need to keep almost our spread to the US intact as well, which actually imply that we probably need to increase interest rates. So it's a very, very tough situation. So I think for now, it's probably a situation of holding where we are with not an immediate opportunity to actually see further cuts in interest rates.
Final question. What are the political implications of this? And I'll say it to you. The first commentator we had on the show, Economist anyway, said that she thought that there had been a slowdown in the intensity that we experienced and we enjoyed when Mr. Ramaphosa first came into office. There's been a slackening off. There hasn't been the same pronouncements. There hasn't been the same energy. Is there a political sideshow to this? Could people be circling Mr. Ramaphosa now and saying, OK, you've only been there a few months, but you know what politicians are like? They are opportunistic. Is this something that Mr. Ramaphosa and his team must look out for? Or must Mr. Ramaphosa now say, well, my team is not going to be my team for much longer. I need to reshuffle?
Yeah, there's definitely political pressure. We know that the NEC is basically a 50-50 split. So I'm still surprised how fast Mr. Ramaphosa could implement a lot of the changes we've seen. We didn't expect that beginning of December. We thought it's going to be much slower. So there's still credit to be given in terms of what's been done so far. But, a lot of the things that's been implemented, so I agree that it feels like there's now a bit of a quiet period. But now it's basically starting to do the work. And that will take time before we see the results. So we're heading towards an election next year. So we also need to remember that for politicians, it's not just about focusing on the economy and policy, but right now it's more about political propaganda, making sure that you get your voter base on your side. So we're definitely seeing more factional kind of arguments, opposition infighting, not only in the ANC, but also within the other opposition parties. And unfortunately, that always takes away the focus from what's really important. So, the real important thing is to actually get the economy going. But I think for the next 12 months until the election next year, most politicians will more than likely focus on other things that they believe can secure them votes. And that's probably why, despite all the positive changes we've seen, suddenly there's quite a lot of social unrest all around the country. And I think that is part of heading towards the elections, and that is something that we will need to deal with in this challenging environment.
Just very final question. I promise you it's the last one. Put your fund manager's hat on now briefly and have a look at the morning meeting you're going to have tomorrow with your team at Citadel, which I presume you will have, because this is an interesting situation. Look at the way the banks have been slaughtered today. Would you sit down and say now, hold steady, don't panic, or would you say we ought to have a look at this because it's quite serious? What's your stance going to be?
Yeah, I think, we tend to be longer term investors, so 1 quarter GDP growth won't necessarily change our mind. We normally take a 3-year view in terms of the economic cycle and what that means. Add to that things like the policy changes that's taking place. As long as we committed to that, it still means that in the next 3 years, South Africa can look a little bit better. We can get to growth of around 2%, and that should be supportive of a lot of the local South African companies. So we're still, in a sense, saying that, I think the rand is still offering an opportunity to externalize money into the offshore markets, but that opportunity is not going to last very long. We already started to see that the rand is slipping for global reasons more than anything else. Argentina, Turkey, China stimulating less, and also a stronger dollar. So we tend to prefer still more offshore, but whatever we keep on the local side, given our view that over the next 3 years things are probably going to look a little bit better compared to the past 3 years, given the change in regime. But like I said right at the start, you can't expect to see that in the first quarter. But on that basis, we still like to keep some exposure to, especially SA Inc., locally South African companies in this kind of environment.
Yeah, thanks for the extended chat, Maarten. Great analysis. That's Maarten Ackerman, Chief Economist at Citadel in Cape